morning, everyone. Welcome to this morning's edition of MPC Markets Morning Call, 20th of August, 2025. Stocks headed lower overnight as investors rotated out of tech. So we sort of drifted lower for a third day in a row, just ahead of the Jackson Hole Symposium later this week. Tech stocks felt the brunt of the pain. And I do believe a fair few investors are paying a lot of close attention to the recent stock rotation, with money coming out of the big tech names into other parts of the market. Obviously, we've had very significant gains, and as you can see here, Nasdaq down 1.9 for the week, down 1.39 overnight, whereas the Dow's up 1% for the week. That rotation is very prevalent but look, 1 week doesn't necessarily make a massive trend, but there's a couple of famous economists out there. James Riley at Capital Economics is highlighting that the similar phenomenon took place sort of during the final stage of the dot-com bubble. I wouldn't necessarily describe this in the same context as the dot-com bubble, because I think a lot of these companies are far more financially stable than what they were in 2001. They were all sort of fairly fledgling companies, whereas now they're the largest companies in the world, and bigger than most economies, essentially. OpenAI's Sam Altman also recently warned of a looming AI bubble as well. You've got Warren Buffett, a lot of cash. We gave a recommendation buy for GQG Partners yesterday, which has been significantly hit on the back of funds under management outflow, which 1.4 billion of their 168 billion under management. But apparently the institutional client was unhappy that they'd gone back to cash. I agree with Warren, and I agree with GQG. I'm genuinely surprised we're up here in the first place, particularly after what's happened. I think and as I've been saying since May, or since April, basically, I've predicted that drop off in April, in Liberation Day, and we bought towards the lows. I didn't think it would get anywhere near this high again. But as I've been saying all along, the next leg down will be on economic numbers and the tariff effects and the employment market softening. Trump needing rates down, and he'll need softer economic numbers, and putting in his own, his own people in the Statistics Bureau. I think that will line up with the seasonal weakness overall. So, yeah, as you can see with this heat map, that shift out of tech into the rest of the market is very prevalent. So you've got Tesla, Amazon, all the Mag 7, the semiconductors, Oracle, Palantir, etc., all of the super hot stocks this year, all in the red, and the rest of the market essentially in the green. So I think that's probably one of the best examples of a rotation, and one of the most pronounced examples of a rotation out of tech. And I will just introduce to you guys why, essentially. So the Schiller, this is metrics which are commonly used to tell whether a market's overvalued. So the Schiller-Kate ratio is like a 10-year average of PE ratio, used quite often by Buffett. The Buffett indicator as well is, relative to the mean, is sort of that market cap to GDP. Similar to the one at the bottom, severely overvalued. Once it gets over 150, that's when he starts going back to cash. So at like 207%, we're severely overvalued there. And Tobin's Q, price to book ratio above 3, we're currently at 4. Dividend yield, but it's below 2, it's at 1.4. Above 2 in price to sales at 2.7. So look, it's not just one metric screaming that we're overvalued. It is, well, what's that? 1, 2, 3, 4, about 9 metrics. And the market doesn't tend to go sideways these days. I did a little bit of a study recently, just for my own reference, whereby markets have changed in the 30 years I've been in markets, and pre-2009 we would have elongated periods of just sideways. But I think with the algorithmic trading and the momentum trading and the systemized trading that goes on globally now, where it's just all automated, there doesn't seem to be these periods of sideways. We're either going up or we're going down. So that's where we tend to get those overextensions to the upside and or obviously to the downside, and those big V-shaped moves. So at the moment, this is probably the most sideways we've been, 3 days, or probably 5 or 6 days, trading days, that is, at least, where we've been sort of going nowhere overall. There's no earnings catalyst. There's no economic number catalyst. So, and it is really shaping up for that September period to be, to be seasonally weak overall. So, while we're taking advantage of the volatility via some structured investments where we're getting some nice leverage to the upside. We're also tying in a 3-month insurance policy with that covers any immediate downside. So we are really cautious at this point. James Hardy, I think, reported overnight, just looking at the calendar here, Santos will be today, the Lottery Corp, APA. There's a couple of smaller names as well. Clarity Pharma, Superloop. Superloop's had a great run lately. Clarity's got a large short in it, so I don't know what they'd be updating on, to be honest. It's really about drug approvals. They've got enough cash to last them for about 7 years, and they're going to be revenue generating within about 2. So, but there could be some severe movement if there is any form of good news out of Clarity Pharma, which is CU6. Just on the basis that there is a significant short position in that. TJX, Target and Lowe's, they were essentially fairly flat. We got Walmart coming up on Thursday as well, was also sort of flat overnight. Baidu and Baba as well. Baba's not on there, but we was having a look yesterday, sometime this week as well. So both fairly undervalued. I think the Chinese AI stocks are pretty undervalued. In a bull market, you want to go with momentum. So they, obviously the money gets sucked up by the US hyperscalers. But I sort of think that they present fairly low risk in terms of valuation compared to the US. Palo Alto, which is one of our picks leading into earnings on the Global Alpha. It was up about, I think it was up about 5 or 6% in the aftermarket yesterday after earnings, and a really positive outlook overall. Ended up about 3%, but the market really liked that. I think it's just a little bit unlucky that it managed to catch that tech rotation at the same time where it delivered decent earnings. So, but this is the sort of thing we're looking at. We've had 5 years since we bounced out of COVID. Realistically, we've had a couple of little, we've had a couple of freakouts here and there, but this is really the only time we've had these metrics at these elevated levels. The longer we stay here, or the further we extend, the worse it's going to get on the downside when it does, eventually correct. So I would be hoping for, a stabilization on a broad, in the broad scheme of things, where we settle back into the middle of the range from April, and possibly just that might set us up for, the Santa rally or whatever. But if we were to extend from here, these metrics are only going to get worse. And then, unfortunately, what goes up, quite often must come down, and it'll come down with a bigger thud. So it's a bit of a case of be careful what you wish for, in terms of, everyone's hoping for rate cuts. Realistically, the average moves down 10% after the first rate cut because it's due to weaker economic numbers. We are looking at that first rate cut in September. Earnings are out of the way. We don't tend to move from the next level to the downside over earnings as well. So overall, we are sticking to our plan of returning to cash. That plan's been in place for quite some time. Again, I'm pretty surprised we managed to get here in the first place. Probably could have squeezed a little bit more out of the upside move from the stuff we bought in April. But it is the way of things. Capital conservation is also a part of making sure that portfolios deliver consistent returns, not just not wild swinging returns. Commodities, US dollar was slightly higher. Just a bad day for commodities overall. A little bit of risk off in silver, copper, platinum, particularly. Uranium got hit. Coal was up slightly. Iron ore drifted back a little bit. It gave back a bit of ground from the rally last week, and Bitcoin was off as well. So there is definitely, with Bitcoin, uranium, silver, copper, platinum starting to drift lower. That's a bit of a risk-off sentiment as well, particularly as the Aussie dollar is down 1.8%, whereas the US dollar is only up 0.2%. That the Australian dollar is considered a risk currency, so that's another sort of red flag for risk-off sentiment as well. So we will be very focused on Aussie earnings today, and our market actually survived pretty well overnight. The SPI was up 20 odd points. That tracks, to be honest. We're not tech heavy, and it was all the selling was in tech last night. So I don't expect too much out of today. Obviously, a severe move in CSL yesterday. Still really not sure what the market hated about it. But there's uncertainty in potentially breaking off the vaccines business, and that investors don't like uncertainty. But we're at 52-week lows, so and then any normal we trimmed. We had a large position between 240 and high 220s. We trimmed around the 270 mark or the high 260s. Recently, we took a third off, so we got about our average position on. If we weren't broadly bearish, we'd be buying, but at the moment, we probably just see how this plays out. There's it doesn't seem to be any major value in the individual stocks in trying to fade those moves. So we'll just keep an eye on it. Still a very solid company. It's certainly not. It's certainly not going too far. I wouldn't have thought maybe it goes hunting for 200, but it's probably going to be great buying at that point. But yeah, it's just very typical Australian tall poppy syndrome. Everyone loves in the newspapers here, the Financial Review. There's 10 times more negative stories in the Fin Review than there is, when someone's doing well. That's probably why our market always seems to lag quite a bit. Investors are fairly, fairly in tune with their tall poppy syndrome feels. So, but yeah, we'll keep an eye on that overall. But I would expect it will be a significantly good buy at some juncture, and we will, but we will see how things pan out. We'll be largely on the sell side, I would say, until around about the late September period. So as I said, we have released a hyperscaling AI, obviously within a little insurance policy and attached hedge on it as well. Focusing around sort of the key ingredients and key resources and the hyperscalers themselves in an enhanced growth strategy, which is a leverage strategy with capital protection. Check out our socials if you want to have a look at that, and you can download the investment summary there. But you'd be getting somewhere in the vicinity of 5 to 6 times leverage and cap downside as well. Playing into the likes of copper, water, power, nuclear via small modular reactors, etc., and then some of the top names in both China and the US in terms of hyperscaling. So check it out. It's sophisticated only. And but I mean, it's still, if you're only retail, it's still well worth a read, because the first 8 pages are more just about the investment thesis and why we think what we are and why we chose what we chose. So yeah, check it out. And I hope everyone has a great day. Again in Sydney, if you stay dry, and I will speak to you tomorrow morning. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.